Chapter 10 is dealing with the money supply process, and we'll talk a little bit more about what the Fed does to kind of control some of that. And we'll feed a little bit off of the last chapter. So what it introduces is this term called a monetary base. So in a nutshell, the monetary base is our currency that's in circulation, plus the bank reserves. You could also add the coin, but they feel like the coin is fairly immaterial at this point. So just the currency in circulation plus our bank reserves makes up the monetary base. So our currency in circulation is basically all the cash that we hold. So the cash that's in our wallet, the cash that is in cash registers in stores across the country, things that we're actually not depositing into the bank, at least as of yet. Then the bank reserves are what the bank needs to maintain based on the deposits that are in their accounts. So then how the Fed can adjust that is they could change that reserve requirement. But we learned in the last chapter, while that should be a very adequate tool for them to control it, it isn't always, because sometimes banks will hold more because they have need to if people are using the ATMs and making withdrawals at a higher rate than they anticipate, or people who are sweeping the money out of their accounts and into money markets and then sweeping it back. So those are things that the bank is going to make the decision to do. So even if the Fed increases that or decreases it, the banks may not change. I mean, they may already be over that amount that they're holding. And then it also talks about there is an exemption amount. So they take the deposits that they have and they can subtract this exemption amount, and then that remainder is what they need to have the reserves on. And as that exemption amount increases, it's going to lower the amount that they need to have on reserves, which would then lower the monetary base. And then in an expansionary open market operation, the banks would go out and they would buy in the secondary market government bonds. So people like you and I who maybe hold government bonds and we're wanting to sell them in, the Fed would go out and buy those bonds. If they buy them from me, then I take my money and I deposit it into my bank account. So then that's going to increase the monetary supply, the monetary base or the money supply. So then that's the Fed's way of being able to say, okay, we're going to take so much money and plummet it back into the economy by buying those bonds from individuals who hold them, because then that money will then get deposited into banks and the banks can then loan it out. They could also reverse that. They could sell their government bonds, which means they would be taking money from the public and putting it back into the Federal Reserve, which takes it out of the banking system, if they wanted to try to contradict or bring the market down or contract the market. They also issue discount loans. So we talked about those in the last chapter. They have like a discount window that they say, hey, we've got $10 million. And again, the Fed is the lender of last resort for those banks. So those banks could come in, borrow the money at whatever rate they're going to be charged, and then put that money back into their banks where they loan it out. And it again increases the money supply. But so when we compare the two choices that the banks could use, the open market operations or the discount loans, they would prefer the open market operations because that they can control. They can say, we've got $5 million, we're going to go out and buy $5 million worth of bonds. They can't control what people do with it if they deposit it in the bank or they take it in currency, but either way that increases the monetary base. Or if they make a discount loan, they can't control that the banks will take it. I mean, they could say, hey, we got $10 million to offer, but you can't make the banks borrow it if they don't come and want to do it. And we talked about some reasons in the last chapter why they would not want to. Then the second section gets into how does the non-bank public influence this monetary base. So cash holdings, if we hold more or less cash, that can impact it. And we'll see when we get into that money multiplier, you'll see how that is. Because just the basic formula, you're saying, okay, currency in circulation plus the reserves is the monetary base. If there's more currency versus deposits, you think it would level out. But that whole money multiplier will say the more that's in deposits versus currency, the more the banks have to loan, and the more the banks can loan, the more that the money supply increases. Then it talks about the Treasury making some foreign exchange interventions, and we'll have a whole chapter that we talk about that. But the Fed could decide to go out and buy like the yen or the euro or the peso if they felt, there's always a exchange rate between how the U.S. dollar is faring with the euro or how it's faring with the yen. And if the government has more of a reason to say, like the textbook gives you the example, if they want to maybe invest in Chinese bonds or Japanese bonds or some sort of the bond market in our international areas, they may choose to buy those currencies to impact what the price is, so that when they buy the bond, they can get a better deal or a better price. So we'll probably have a whole chapter where we talk about those different things. But if they do that, if they buy the Japanese yen, then they're gonna get the money and they're gonna deposit it into the banks, which again is going to increase our monetary base. And then the Fed also just has their government checking account where all of our taxes get deposited into, and they pay their bills out of it. So those kind of tend to wash, but they also too can impact the monetary base. So then the textbook shows you this money multiplier, and the money multiplier is 1 plus K, and K is our currency ratio. The currency ratio is calculated by taking the currency that's held divided by the deposits. So if there's more currency over deposits, you'll have a number greater than 1. If people are holding less currency and more deposits, you'll have a decimal. It'll be under 1. But that's on the top of the equation, or it's 1 plus that. Then when we come down to the bottom, we'll have again, the currency ratio, the K, plus the required reserve ratio plus the excess reserve ratio. So we'll divide those into 1 plus our currency ratio. So then it gets into okay, well, once we kind of have that formula and we think about it, what things impact it? So if we change our currency ratio, so again, the currency held divided by our deposits, if the currency gets higher and that number gets higher, there's an inverse relationship. The money multiplier is going to go down. If it's the other way, if we hold more deposits than we do cash, the K is going to go down and the money multiplier is going to go up. And that just seems logical. If we hold cash, we can't loan it out. If we deposit it in the banks can, and that would increase the money supply. Then there can be just I skipped one, the level of the market development. So this is an interesting thought. There's areas of the world, possibly even areas of the country, where we do not have organized banking systems. So then everybody's cash basis. They're holding cash, they're buying with cash. In that case, they'd have to save cash to buy a car or to buy an asset. Whereas if, like in our community, we have tons of banks and credit unions, there's all kinds of places we can go. So in that case, we can borrow money, we can increase our economy, which can increase the money supply. So all of that is like a snowball effect. So if you don't have it, your economy's not growing. If you do have it, the economy can grow. Then there can just be a general public distrust of banks, and I feel like that's also cyclical, kinds of comes and goes with our economy. If we hear of ethical violations in the banking industry, all of a sudden we are losing trust in those banks and not wanting to make deposits. If we ever hear like a bank went bankrupt, again, that's going to increase the holding of cash. People are going to want that cash. If they do change, if there's an excess in the reserve ratio, that's also going to decrease the money supply, because that means the banks are holding more than what's required. For some reason, they're not loaning it out. They're choosing to hold it, which is not going to increase the money supply. If we reduce that required reserve ratio, that would increase the money supply. If we increase it, that's going to decrease it. So you kind of want to know the variables that are in that formula and what the government does that may impact those. Then it talks about that quantitative easing, and again gives you some graphs. And like we talked about in that quantitative easing in the last chapter, those were things that were put into place to try to get us out of that deep recession that we were in. So we had the mortgage fiasco, people were walking away from their mortgages. So the government stepped in, bought some of those mortgage-backed securities, invested money into the stock market, did whatever they could to kind of bring those things back. So then that's basically what this chapter is about. So it's a fairly short chapter, and it kind of just, again, is looking at that monetary base and what changes it, and then that money multiplier.